The stock market impacts everyone, driving businesses and offering investment opportunities. Understanding the stock market empowers you to make informed financial decisions. The stock market is a dynamic hub where companies raise capital and investors trade shares. Buying stock means owning a piece of a company and sharing in its success. The stock market fuels economic growth by providing capital for innovation and expansion. The stock market operates like an auction, with prices driven by buyer and seller interactions. Stock prices are influenced by supply and demand, driven by various factors. Analyzing supply and demand helps investors make informed decisions. A company's performance and financial health significantly impact its stock price. Economic conditions like interest rates and inflation influence stock market trends. Unpredictable factors like geopolitical events and investor sentiment can sway stock prices. Section 1. Opening the gateway. Ready to dip your toes into the stock market? The good news is, getting started is easier than you might think. The first step is to open a brokerage account. Think of a brokerage account like your gateway to the stock market. It's a platform that allows you to buy and sell stocks, bonds, and other investments. There are numerous brokerage firms out there, each with its own set of features, fees, and investment options. Some popular online brokerages include Robinhood, Fidelity, Charles Schwab, and TD Ameritrade. When choosing a brokerage, it's important to consider factors like trading fees, account minimums, research tools, and customer support. Opening a brokerage account is typically a straightforward process. You'll need to provide some personal information, such as your name, address, social security number, and employment status. You'll also need to answer some questions about your investment experience and risk tolerance. Once your account is open, you'll need to fund it. This involves transferring money from your bank account to your brokerage account. Most brokerages offer various funding options, including electronic bank transfers, wire transfers, and checks. Once your account is funded, you're ready to start buying stocks. Section 2. Research. Your secret weapon. Walking into the stock market without research is like walking into a maze blindfolded. You might stumble upon a hidden treasure, but it's more likely you'll end up going in circles or hitting a dead end. Before you invest a single dollar, it's crucial to do your homework and understand what you're buying. Start by identifying companies that pique your interest. These could be companies whose products or services you admire, industries you're passionate about, or businesses with a solid track record of growth and profitability. Once you have a few companies in mind, it's time to dig deeper. One of the best resources for researching stocks is a company's annual report, also known as a 10K filing. This comprehensive document provides a detailed overview of the company's financial health, business operations, management team, and future outlook. You can typically find a company's 10K filing on its investor relations website or through the Securities and Exchange Commission's (SEC) EDGAR database. In addition to financial statements, pay close attention to a company's management team, competitive landscape, and industry trends. A strong management team with a clear vision can be a major asset, while a company operating in a highly competitive or rapidly changing industry may face greater challenges. Section 3. Placing your bets. You've opened your brokerage account and identified some promising stocks. Now it's time to place your trades. Before you hit buy, understand key concepts. Buying a stock is betting its price will go up. Buy low, sell high, pocket the profit. Remember, stock prices are volatile. Your investment could go down. Two main order types: market and limit. Market orders buy or sell at the best available price. Limit orders set a specific price. More control but no guarantee of execution. Understanding the benchmarks. You often hear phrases like "the market is up today" or "the market took a dip." But what exactly does the market refer to? That's where stock indices come in. They act like compasses, giving us a general sense of direction. Think of a stock index as a carefully selected basket of stocks. The most well-known stock indices are practically household names: the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite. Section 2. Beyond the Big Three. While the Dow, S&P 500, and NASDAQ grab most of the headlines, they're just the tip of the iceberg. Numerous other stock indices cater to specific sectors, investment styles, or geographic regions. For sector-specific insights, you have indices like the Energy Select Sector SPDR Fund, XLE, or the Technology Select Sector SPDR Fund, XLK. These indices allow investors to track the performance of specific industries they're interested in. For instance, the Russell 2000 Index focuses on small-cap companies. On the other hand, the Dividend Aristocrats Index tracks companies with a long history of consistently increasing their dividends. Internationally, you have indices like the FTSE 100, United Kingdom, the Nikkei 225, Japan, and the Hang Seng Index, Hong Kong. These indices provide insights into the performance of stock markets in different parts of the world. Understanding different stock indices empowers you to make informed investment decisions. Just like a well-balanced meal includes a variety of food groups, a well-rounded investment portfolio comprises different types of stocks. Each type of stock comes with its own set of characteristics, risks, and potential rewards. One fundamental distinction is between common stock and preferred stock. Common stock is the most prevalent type. You profit from capital appreciation and dividends. Preferred stock offers fixed dividends, appealing to income-oriented investors. However, preferred stockholders usually don't have voting rights. While growth stocks entice investors with their high growth potential, they also tend to be more volatile. Value stocks are like the seasoned veterans of the stock market, often well-established businesses with a solid track record. Blue-chip stocks are the bedrock of a well-diversified portfolio, shares in large, well-established companies. Think of companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble. They tend to be less volatile and often pay consistent dividends, appealing to conservative investors. Understanding these classifications can help you navigate the vast universe of stocks and create a portfolio that aligns with your goals. So, you've dipped your toes into the stock market, but how do you actually make money from stocks? There are clear strategies for generating wealth. The most straightforward way is through capital appreciation. Buy low, sell high. And don't forget dividends, a bonus for owning a piece of the company. Dividends can be particularly appealing to income-oriented investors, such as retirees or those seeking a regular cash flow from their investments. However, it's important to note that not all companies pay dividends. Some companies, especially those in growth phases, may choose to reinvest their profits back into the business rather than distributing them to shareholders. Now imagine taking those dividend payments and reinvesting them back into the stock market. Over time, those reinvested dividends can purchase more shares, which in turn generate more dividends. This snowball effect is known as compounding, and it's one of the most powerful forces in finance. Compounding allows your investments to grow exponentially over time. The longer you stay invested, the more your money can work for you, generating returns on top of previous returns. It's like planting a tree. The earlier you plant it, the more time it has to grow and flourish. Of course, the stock market is not without its risks. Stock prices can be volatile, and there's always the possibility of losing money, especially in the short term. However, by understanding the fundamental principles of investing, diversifying your portfolio, and staying focused on the long term, you can harness the power of the stock market to potentially build wealth and achieve your financial goals. As we've journeyed through the ins and outs of the stock market, one key takeaway emerges. Knowledge is power. What was once a mysterious realm of charts, jargon, and fluctuating numbers can become a source of empowerment, offering a path to financial growth and stability. Remember, the stock market isn't just a playground for Wall Street tycoons. It's a dynamic space where individuals like you and me can participate in the growth of companies we believe in, potentially building wealth and securing our financial futures. The key is to approach it with a healthy dose of knowledge, a dash of patience, and a long-term perspective. Think back to when you first embarked on this journey. The stock market might have seemed like an intimidating labyrinth, filled with cryptic terminology and complex concepts. But with each step we took, each concept we demystified, the fog began to clear. You've learned how the stock market works, the forces that drive its movements, and the strategies for making informed investment decisions. Now, armed with this newfound knowledge, you're no longer a passive observer. You're an informed participant, capable of navigating the market with a sense of purpose and control. You understand that while risks are inherent in any investment, they can be mitigated through careful research, diversification, and a long-term outlook. As you continue your journey in the stock market, remember that learning never truly ends. The market is constantly evolving, presenting new opportunities and challenges along the way. Stay curious, stay informed, and never be afraid to ask questions. Seek out reliable sources of information, such as reputable financial publications, industry websites, and educational resources. Consider consulting with a financial advisor who can provide personalized guidance tailored to your specific financial goals and risk tolerance. Above all, remember that investing is a marathon, not a sprint. Don't get caught up in the hype of short-term market fluctuations or the allure of get-rich-quick schemes. Instead, focus on building a diversified portfolio of quality investments that align with your long-term financial goals. The stock market, with all its complexities and uncertainties, can be a powerful engine for wealth creation and financial security. By embracing knowledge, cultivating patience, and staying focused on the long term, you can harness its potential to achieve your financial aspirations and navigate the market with confidence. And as always, if you enjoyed this video, make sure to give it a thumbs up and subscribe to the channel for more money-making tips and strategies. Until next time, keep hustling and stay focused.